Hey, I'm not sure if it's on yet. Let's see. Dun. Bum. Yes, we are live. Cool. How's it going? Got a couple seconds. I'll give it a couple seconds. Yeah, there we go. So this is my first time doing a live stream. So I want to make sure it's just working in general. Hey, Pioneering Markets, howdy, man. Can you hear me? I'm guessing you can. Happy hump day. Got the seltzer out. Oh. First, nice. All right, good. I'm guessing the stream is working then. Cool. All right, I got some stuff off to the side, so I might be looking over to the side for a bit here and there. And we're probably going to give it a minute or two just to give some people the opportunity to jump on. And I'm going to go back to YouTube and make sure it looks pretty good. All right. Excellent condition. Cool. All right. Couple viewers. Sweet. Hey, Ricky, what's up, man? How you doing? Cool. I'm using OBS for this, so it's a bit different than StreamYard, and I don't know if OBS would work for like a multi-person stream, but so far for just an individual stream, it's pretty sweet. I'm liking it. All right, so I'm gonna pull up the first question that we got. So if you guys don't know, I'm guessing you know, I have a Discord called Stone Cold Investors, and I just posted a little channel in there today asking for just live stream topics. So we got a couple that we'll go through. And yeah, StreamYard, yeah. I've used StreamYard a couple times. It's pretty nice, but Kraken, yeah. Hey man, they made a good run. It was much more than I was expecting, but so if you are in the Discord and you have any Q&As or any questions or anything like that, drop them in that chat that I created today, and I might do a weekly live stream and just go over some of those questions and maybe some different companies and whatnot. So the first one we got here is Google still a good investment for the next decade? I wish I had a crystal ball. All the bear theses around the company are talking about its number one revenue source is being diminished by AI. Yeah, so if anything, I look at the negative sentiment around Google and the potential impact for their ads from AI as a potential opportunity. Google's, one that I personally would like to accumulate a little bit more of. So it really just depends on, what you think is going to happen long term. I do have some dogs down here, so if you hear them, I am sorry. And my wife might barge in here and take them eventually. So she might make an appearance. No selling of courses, man. Sorry, Dex. You can just, go donate it to charity or something. But so for Google, it is a little bit of a concern, I guess, maybe AI with their ad spend, but I'm honestly not that worried about it, because if you look at I just don't see Microsoft or any type of large language model where they have an interface like ChatGPT. How are they going to monetize that with ads? And I think eventually they might actually get into regulatory issues with scraping the data from websites. and not passing any type of monetization off to those websites if they're essentially just stealing the information and then regurgitating it in a large language model. So I actually have the view that we could see some interesting legal battles eventually from this, because essentially you're going to be these large tech companies scraping data from all over the web and then reusing that data and probably showing sources on the side, but not giving the full impact of like that traffic to that website. So we'll see what happens there. If we go over to Google and we just look at their last Q1, we can kind of see the breakdown of their revenue. Google search and other is up a little bit. Google Network was down a bit. Google or YouTube ads was down a little bit year over year. And I don't think, like, obviously AI is not going to affect YouTube ads. $6.90 a month. All right, man. Venmo me. But so I think like YouTube ads is not going to be obviously affected at all from, I would say, like large language models, because that's going to be more entertainment. Long term, I think YouTube is going to be a better source of growth more than anything. I might be biased just because I consume a lot of YouTube and I'm on YouTube right now, but I don't think YouTube is really going to see any type of decrease from AI in a large language model, chat GPT type of applications. So I'm not too worried about that. I think YouTube is going to have a really nice growth runway long term, and the ad revenue from YouTube is most likely just going to be conditioned on, advertised spend, which might fluctuate here and there, but should see decent growth along with just the overall platform over time. So Google search, it still saw an increase. I don't know. I'm just not buying that like ChatGPT or these large language models are going to really impact the ad space from a search perspective that much. I think the biggest impact that they could have, especially with Bing, is if Bing ends up taking more, I would say, browser search from Google, because people end up liking Bing and are using ChatGPT alongside with it. So I think that could potentially happen. But I mean, Google's going to have does Google have Bard? I don't know. I think Bard, something like that. So they'll have their own competitive, LLM platform that they're going to be able to monetize. The section of Google that I'm most interested in, and that I think people are just kind of like, I don't know, not paying a lot of attention to because they're not the like number one, number two player, is the cloud space, because their cloud space is still seeing really solid growth, and it's going to have a pretty large runway. And when we get into AI, especially, if companies are trying to use hyperscalers to run AI specific models, that's something that's going to be a tailwind for not only, Azure and AWS, but also Google Cloud. So we'll see what they can kind of squeeze out of that. So I'm not too worried, honestly, about AI impacting Google's ad revenue. I think it might flux. I kind of hope it does. I kind of hope it takes like a nasty hit, like for some reason, like briefly, or we just get really, really bad sentiment. Like it sees maybe a little bit of a dip and the market just goes on this selling spree, get a lot of good negative momentum, and Google gets back down into some attractive ranges. So yeah, I think I was buying it probably low 100s and then down to the 80s. I think my average is around 94 right now. But yeah, if it got back down to 80s, 70s, 60s, that would be a for me personally a fun one to accumulate in those ranges. So I'm not too worried about it. We'll see how it plays out though. I could be wrong. It's very, very possible. Let's see. I'm gonna go check the stream real quick, make sure we're still good. Looks like it. All right, cool. Dun. All right, so on to the next one. got bacon memes over here. So if relevant, how do you incorporate share buybacks or dilution in your valuation while not double counting? And I think that like double counting, it's something I kind of had to think about because it's hard to double count buybacks. It's just kind of a function of the valuation and the future cash flows on a per share basis. So he kind of he went on a little bit more on that and gave me a bit of a larger breakdown. And then I think Doc kind of chimed up and said, as an example, EM used to have make an assumption about buybacks in their DCF calculator, and they later stopped doing it because of double counting. I don't totally understand that, and I will go over my view of buybacks and just kind of show you why I don't get that. So buybacks, in my evaluation, right? Basically, I in each scenario, I look at my bottom line growth, right? Which I have to account for what I think if they're going to have any type of margin expansion or what the margins are going to be, what their revenue is going to be going forward, and what kind of bottom line growth that could lead to going forward. So I'm looking at bottom line growth. I'm looking at the fair value market cap of the overall company, and that's comprised of essentially taking into account a change in overall outstanding shares, which will include buybacks or dilution, so double-edged sword. And then in another model that I run, which is this is my market cap template, and here's my EV template, enterprise value template. And this one has a little bit additional fields that it uses for the valuation. So it goes off of enterprise value and then has a debt structure where I can actually look at the debt structure to essentially try to increase or decrease the enterprise value going forward, and kind of account for the risks in the debt that they have going forward. So if there is a company that's buying back, say 5% of their float, but they're using straight straight debt to do that, then something like this would most likely account for it, right? So on an enterprise yield valuation, you would basically just tack on the debt to the enterprise value of the company. The share count would go down, the buybacks would kick in, but it would just be canceled out by the enterprise value, assuming you're taking 5% debt to buy it back 5% shares. It's just going to cancel out. And then on a market cap basis, if you're looking at market cap valuation, what would happen is, or what you could also do, is you could take into account the debt increasing, potentially lowering your future multiple, and what the market is going to essentially value the company at, assuming it's including that debt that they're taking on, as well as the buybacks. So for my valuation, and this isn't really even a straight, a specific evaluation on Google. My wife's coming home, so she'll make an appearance, maybe. But so here, we can see for dilution on Google right here, I've got 2.3% or buybacks 2.3% to 1.53%. And we can kind of see that from the last couple of years, they've actually increased their buybacks. Now, if we go to the overall multiples, bottom line yield multiples, they're sitting about 4% right now, about 4.5% on EBIT, 4.2 or 4% on free cash flow, and 3.8% on net yield. So usually what I look for is, does the company have the ability from their straight cash flow to return capital to shareholders, assuming they don't have a better place to reinvest it, right? If Google can take that cash flow and they can take 10 billion and invest it and get a return of 20%, well, that's a lot better than buying back shares that are only going to be yielding like, 3.84% on the bottom line through the company. I love that. Yeah. I had a, whoa, Mason is angry. 1 second, I'm going to go let my dogs out. There you go, buddy. All right. So that was my Great Dane. But so assuming that they have that that ability to invest the capital elsewhere and get like a 20% yield on it, then they shouldn't be doing buybacks, right? They should be growing because they're going to be able to use that capital more efficiently. But for buybacks specifically, what I'm looking at in my evaluations is how buybacks are going to kind of affect the share number at the end, and then also obviously the regular EBIT or bottom line growth at the end of the 5-year period, right? So if we look at just this worst case scenario that is on Google right now, so we've got EBIT of 107, net income of 89, free cash flow of 94, and share count of 11,874. So we kind of see that that decrease in shares over that 5-year period of time, and then we can extrapolate over our using our yield multiple, our fair value market cap, and our share price. So this is kind of like a pricing model that uses, bottom line cash flows as pretty much the main multiple at the end of the 5-year period. So for example, let's say that everything basically comes down to a per share basis and that ending multiple, right? So if I am decreasing my share count by 1.53% and my bottom line growth is 8.87, then I'm basically increasing my per share metrics on that's about a 10.3% yearly clip, right? So if I theoretically was looking at a company that let's say theoretically I'm looking at a company that has like 0% or 5% growth and 5% buybacks, then you're essentially looking at like on a per share basis about 10%, something like that. I might be oversimplifying this, but in the next, say, 5-year period, what could happen though is if your growth goes from 5% to 0%, well, your ending multiple could be like really, really bad, right? So the ending multiple is going to basically be a function of what your share price is going to be, right? So if the market's looking at this growth at the next 5 years and says, hey, you know what, it's only growing about 8.8% on the bottom line, and assigns it this multiple, then I've got a calculator on the side here. So then it would be 100, divided by 6.1. That would be a P of about 16.39, right? But if we have a much higher growth rate on the bottom line, as well as more shares being discounted or removed from the float, and at the end of the 5-year period, the market is saying, actually, we think this is going to, they're valuing it at a 3.65% yield at the bottom line. Well, that would turn into a, let's see, 3.65. That'd be a PE ratio of about 27, right? So I think in the everything money example, they didn't want to double count it because it's already in the cash flow. But at the end of the 5-year period, what you're doing is you're looking at the number of shares at the end of the 5-year period, and then you're removing that from the float. You're doing the calculation to get to your market cap, but your market cap is going to be really a valuation function at the end of the 5-year period of the market's expectations going forward and valuing those future cash flows, right? So at the end of the 5-year period, if they're still growing at a 17% clip, or like, I don't know, 20% clip or whatever, you know, and the market gives them a 27 PE, obviously that's going to be a lot better if compared to like if they're growing at a 5% clip at the end of the 5-year period and the market's like, oh no, we're going to only value them at 16%. So yeah, it's just I don't know. The only way that I think you could be getting screwed off or screwed up with buybacks is if you're assuming if the buybacks are being done by an increase in debt on the company, and you're assuming that those buybacks are going to increase the EPS, but you're not increasing the risk premium that you have to apply to the company because their debt risk is going up as they leverage up more. So, I mean, and what I think Apple was doing that recently, right? Like they did a bunch of buybacks just based off of debt. Now, granted, you can say that like it was still accretive to investors because they were getting loans at like 1%, and their bottom line yield was like 3 or 4, so they had like a 3% spread, something like that. But yeah, I don't know. So I would not ignore it in your evaluation. Or in my evaluation, I am not going to ignore buybacks or dilution. I'm going to account for them because it's like a critical quantitative part of how I get to my end, basically fair value prices in my 5-year period. You just have to be very aware that buybacks are only one part of what like improves your EPS per share. Right? You're looking at the total aggregate EPS per share, not just the EPS per share just from buybacks. So you need buybacks, and you need bottom line growth that is strengthening. And then at the end of the 5-year period, additionally, the market outlook for the next, 2, 3, 4, 5 years needs to be in a state that is going to apply a multiple to the equity, to get you those 5-year target amounts. So yeah, that's basically how I use it in my model. So I would just say the only way that I can see you double counting buybacks is in the scenario where the buybacks are done strictly from debt and the company is increasing their leverage and their debt because of the buybacks. And in that type of situation, you'll probably get decreasing share count, but also a decreasing multiple for the company because their risk premium is going up because they're more leverage. So that's not good. So that'd be some iffy stuff. But what's up, Fuhat? How you doing, man? Oh man. So how often do you favor an inverse DCF? So I actually had to Google that the other day because I was like, I don't even know what like a inverse DCF is. And to be completely honest, like when I was looking at like how I was going to value like cash flows in a company and try to come up with some type of model that like made sense in my brain, a lot of DCFs like just, I don't know, they didn't make a ton of sense to me. Like they did, but there were just things that I was like, okay, I don't totally understand that. I don't totally understand that. So I almost made a model. I think my model is like a combination of a DCF model and a pricing model, right? So it's like a asset price. It's like a pricing model, but it's based off of, bottom line cash flows. So yeah, I don't know. I would have to look up an inverse DCF. I think I did the other way too. Inverse DCF model. Reverse engineer the current share price of a company. Okay. That's interesting because that somewhat makes sense to me. And you could even say, well, I didn't read that out loud. So from what I can see is that a reverse DCF is trying to do an evaluation on the current company to come up with why the market is evaluating or giving it the valuation that it is. And you could kind of say that I, in a way, incorporate that into my model already, because typically what I'm doing is I'm looking at historical bottom line yields. I'm looking at all of the in a way, I'm looking at how the market has valued those cash flows of that equity over the last 10 years. I'm trying to understand it, and then I'm trying to price it out going forward, right? So typically my spreads in my 5-year targets are, so right here it's between 6.1 to 3.65 average across these three over in the 5-year period. So that gives us a range basically of like, right here to here. So that's basically in the range that the equity is traded at over the last 10 years. So yeah, I should have just Google barred that question. Oh man, seltzer water, man, love it. I love it. 26 minutes, cool. Yeah, so I don't know, like market, I come to more and more the conclusion that the market is usually efficient. However, there's always going to be this one-offs, and it's not guaranteed efficiency long term. Like the longer that you extrapolate out the pricing of the equity, the more efficient the market probably becomes. So it could have, I don't know, like you could have a very drastic range of pricing, but eventually the pricing should always over a long enough period of time correct to the true, I guess, like fair value based off of reasonable cash flow assumptions in the future. Baby church first stream. So I've been using mostly inverse DCF to understand market sentiment and get why. Okay. Yeah, I can see that. Although it's hard because my personal opinion, or kind of the lens that I view the market at now, is that the opportunities that I have as a investor in individual securities is usually when I disagree with the market and I disagree with the majority of people out there, and I have strong backing and strong confidence that I'm correct. Because if I am, then the market should eventually realize it. Other people should eventually realize it. They should eventually realize that those cash flows should not be discounted that much, and it will correct. But the beautiful thing about really, really crappy sentiment and really negative momentum is that it will give you those opportunities. It will also give you opportunities to be a dingus and buy into companies at extremely elevated valuations. Cigna Brothers in Arms. That's right. So it's a double-edged sword, and typically, psychologically, emotionally, people like buying things when they're going up, right? So, man, I'm not good at banks, Fuhat. I'm not good at banks. Well, I mean, I don't know. Maybe I can do some banks someday, but there's probably a lot of other stuff that I'm way better at than banks. So, when you have 10,000 Fuhat, that's right. Yeah, and then basically, when I find something that I want to accumulate and I build out a model for it and I have a fair value, typically I'm going to want to get above a average market return, right? So if I'm assuming that I can get 10% just buying SPY, buying S&P 500, then, why would I mean, honestly, why would I even take the risk of an individual security unless I thought it was going to probably produce at least 15% KGAR, right? Because even if I'm like, oh, I'm going to go for 12%, like, I don't know. I don't know. Like a 12% KGAR, so you get a 2% premium, but you're basically all in on, for that allocation on a single individual company. Unless, I guess, part of the thesis is that the overall market's going to struggle heavily for a period of time, and that security or that sector is going to increase. But yeah, we did get to Google already, man. I can summarize it real quick if you want me to. Summary on Google is I'm not worried about AI. I think that essentially large language models don't really have the structure to be able to capitalize on compounded annual growth rate. Come on, man. I basically don't think that large language models and applications like ChatGPT are structured in a way that are going to remove that advertising revenue away from traditional search engines. And I also believe that eventually large language models are going to probably come under regulatory scrutiny and potentially lawsuits from the owners of the data that they're scraping, and we might get into some fun situations there. So yeah, that's basically my thought. I am very interested in Google's cloud compute. I think if anything, AI might actually provide more of a tailwind to Google than a headwind, because what might be a headwind in the advertising section could be a huge tailwind with the build out of their cloud compute business and the increasing revenue from cloud compute for them. So, yeah, let's see what else we got. Thesis behind MUSA. How you view the business, how it will develop, perform in an EV growing world. You know what? I don't have a huge huge argument for MUSA. My thesis behind MUSA is just looking at their financials and their valuation. I think they're really, really good allocators of capital. I think they're really good operators. They have been returning capital very well at very good points in time and through buybacks, and they have been using the capital for smart growth, right? So it's, I don't know, like, I think MUSA could eventually experience some headwinds from EV, but you got to realize that, like, I don't know, like gas vehicles aren't going to be off the road for probably 30 years, something like that. I think it's like the average kind of end of life vehicle on the road is around 20 years old or so. So it's going to take a long time for us to like, for us to get to where all new cars developed are EVs, for one. And then for the old used cars that are gas to get kind of like pushed out of the used vehicle rotation. During that time, we're going to have huge infrastructure issues, or not issues, but challenges, because we now need to charge all of these vehicles. We could see some form of gas stations converting into high voltage charging to where you can have a quicker charge for your EV. So kind of like a Tesla supercharger, but like different. And even that, I mean, it might even be like advantageous to Tesla to just offer up superchargers to these gas stations, right? If they want to build out the supercharging network, like, cool. So basically the capacity on a vehicle like footprint infrastructure is already going to be there if we're converting a lot of these um, gas stations over to like supercharging networks, and then you would basically have maybe a small amount of premium that they're getting off of the electricity sold or renting the space out to Tesla or other supercharger networks. And then you would get the continued, convenience items, which they usually make a good amount of their profit on. So yeah, MUSA, I'm just kind of like, yeah. If I had to do let's do a valuation on it right now. All right, let's just play around with some numbers, okay? Play around with some numbers. We're gonna decrease growth quite a bit, maybe 12%. Now, if we really wanted to be more accurate, we should go in and look at their forecasts. I would have to revisit my old valuation for this, but if we were just going to like do really dumb down numbers, on something that's trading with that already is trading at a pretty low multiple, they've got a lot of share buybacks. I mean, they're buying back 7% of float, 9% float, 9.9% of float, 7%. So like almost average of 6.2% buybacks over the last 5 years. So we've got a buyback spread between 407 to 620. We're going to go for about 17.5% return. And we could probably, we're going to say decreasing growth to a nominal, like a more normal rate of around 10% midpoint. And let's see, what's their historical multiples have been pretty consistent between that, maybe 5 to 12% mark. So if we saw best case of maybe go -2, yeah, 7.6. We'll do that. Sure. And then a little bit higher of increase. 7. Should get us around almost, let's do 8. Because I kind of want the spread and the future yields to be about 7.6 to 12. And yeah, I mean, they don't have to do much, like at least much more compared to previously to turn out a pretty dang good KGAR right now. So if they keep up, if they can produce an 8% yield from here, I mean, even with zero growth, if you have an 8% yield, and they're just buying back 6% of their float, increasing their EPS just from the share buybacks, they don't have to grow a ton to see a decent amount of appreciation over the 5-year period. So, and these are still pretty dang, like, geez, like, what type of PE is that? Like a 9? Assuming a 9 PE. And best case scenario, maybe a 15 PE. So, pretty modest. Yeah, I just think, looking at how they've managed their capital over the last, 10 years, the buybacks that they've been doing, oh man, it's hard to see. It's hard to see them, I don't know, not going up over 5 years unless they have horrible fundamental issues in the business and they just totally screw themselves over. So I'm going to go over some comments real quick. JP. Okay. Have another drink. FLNC, energy challenges. I'll have to look at that sometime. Let's see. What sectors are you looking at for buying opportunities in the market right now? From JBHBBHBBBH01. So the sectors that I'm looking at right now, and it's actually I think the only thing that I bought the last month has been in the retail space. So that's pretty much been my focus over the last month, has been retail. And then, I did buy, of course, I bought a couple more shares of some REITs because, Gotta buy my REITs, I guess. No, but over the last month, I think I bought into Ulta, Target, Dollar General. Let's see. I bought a little bit of Tyson. Bought some more KRC. Bought some more IIPR. So really, the buys that I'm making right now have mostly been retail and industrial, probably. Because I kind of consider Tyson industrial. It's kind of commoditized. So yeah, that's basically where it's where most of my valuations are that look enticing is stocks in the retail and maybe the industrial space, and then REITs. I mean, we'll see what happens with real estate. I don't know. Who knows? I mean, they are heavily discounted. So, I don't know. I might be wrong. Market might be right. And, but yeah, like around these levels on some REITs, I've been very interested in. Oh, ARE got that short report released. So that was fun. That was one that I have been waiting on, and I think I did my original valuation on it, and I was looking for about 80 to 100 on ARE for to accumulate that one, and I think it's sitting around, I think it's like 115 right now, but 112. So, but it's been looking pretty weak. So you can kind of see the price action off of it has been fairly weak. Like REITs bounced back pretty nicely over the last like couple weeks, and Alexandria just kind of sold off. Part of the reason that I didn't like Alexandria at basically any of these levels over the last year is that I thought that the market was basically not applying a high enough risk. Like, it was basically applying, like, I don't know, no margin of safety for it. And I thought the life science space in particular would have potentially a lot more headwinds than people were expecting, and a lot more competition than people were expecting. Basically, any retail or like any office REIT that I have been following has just been talking about life sciences. Like, oh, life sciences development, so we want to build out our life sciences portfolio. Like, what do you think that's going to do to, I don't know, competition long term? Like, ARE is obviously going to have the advantages in that space because they already have the relationships, they already have the expertise in that. But it seems like it's just the next area of real estate that is kind of getting, I don't know, really focused on. And yeah, I don't know. I think ARE is going to have a lot more competition going forward. But that being said, are we at yeah, we're at 5-year lows now. 5-year lows with ARE. My inner trash panda is coming out, guys. But that being said, yeah, we're getting close. We're getting close to that zone of, $100 to $80. So if ARE can get some more negative momentum and maybe some negative sentiment, maybe a couple flush downs, that will be one that I would consider. I probably would pick it up and increase my overall REIT exposure through ARE in that situation. Like ARE at $80 over a long period of time is probably going to be a pretty solid valuation to buy at. So. Oh dang! I'll have to look at your write-up, Ricky. Shoot, man. Dang. Is that in the that's in the capital mindset community, right? I'll look at that. Looks interesting. Okay, so how do you value REITs? Most REITs are increasing their share count and their dividend payouts exceed their cash flow. All right, so a couple things to keep in mind with REITs is that they have some accounting advantages. We'll just say that, right? So typically, I think mostly REITs are going to raise capital through dilution, right? Unless the share price is really, really low and the valuation is horrible, that's how most REITs are going to do capital raises, is through dilution to raise capital to then go, finish developments and build out their portfolio. Another way is debt, but typically you're going to see a nice mix of debt and dilution. I do not know. Well, I don't think that REITs can't buy back shares, but REITs, in order to be a REIT, you have to pay out about 95% of your net income, I believe, to shareholders in the form of dividends, right? So you basically have a very, very, very high requirement to return most of your cash flow to shareholders in the form of dividends, and why you see a lot of REITs that have payout ratios that exceed their cash flow. It depends on what cash flow metric you're looking at. The dividends usually do not exceed their adjusted funds from operation or their operating cash flow, because typically what will happen is they will be depreciating a tremendous amount of value out of their portfolio through depreciation and amortization of the assets that they hold. So what that does is it drastically lowers their net income number, right? But their operating cash flow is still pretty solid, right? So, and while the depreciation and amortization of the properties can be like legitimate, usually it's going to be, a lot of REITs will do it at an accelerated rate that is like far beyond what it would actually cost for them to reinvest into the building to, like, I don't know, for new tenant improvements or whatever to get leased out. So a lot of times you'll see REITs that they look kind of funky, you know what I mean? Like their net income looks bad and it looks horrible, and then you start looking at their operating cash flow and the amount that they're just depreciating off of their net income, and you're like, oh, okay, it's not that bad. So I actually have a specific REIT valuation template where I can specifically say, you know what, I just want to look at operating cash flow. And when you do that, usually on a lot of REITs, like I would prefer to do funds from operations or AFFO. I cannot get AFFO pulled into my models using financial modeling prep yet. So I think I have a request out for them to see if they can start including a lot of these REIT specific metrics or numbers like AFFO. But I can look at operating cash flow. So when we look at like something like KRC, we will see, and KRC is a better one. KRC is one that actually, like, their net income and their EBIT actually still looks somewhat decent. Some of these REITs that I've seen, like their net income is just gone. Just gone because they're depreciating it away. But if we look at KRC, you'll kind of see that I look at the dividends paid, the net income, and then the operating cash flow. You'll see the net income for KRC right here is pretty dang bad, right? It's like $25.94, and their dividends paid is $24.75. So legally, they have to pay out what I think it's 95% of that net income in the form of dividends. So legally, they have to. Look at their operating cash flow though. 592, right? So their operating cash flow is more than double their net income. So if we then go down, we'll look at some different metrics here. We can see, I look at, especially for REITs, I look at per share metrics because they do have a lot of that dilution, and people will just see like the revenue growth or the net income growth or the operating cash flow growth, and they won't take into account the dilution that the company's like basically putting forward to raise the funds to increase those revenues. So what you want to look at is you want to look at how accretive all the developments of the REIT are being essentially to the bottom line on a per share basis. So if we look at operating cash flow per share and dividend ratio, so we can kind of see here that dividend ratio for KRC is about 41%, 41.8% when compared to operating cash flow. That's a lot better than it being at probably around 95% or so. If you were just looking at a traditional dividend payout ratio that's looking specifically just at the dividend payout compared to the net income. So, 1 second, guys. Got somebody bothering me. Dun, dun, dun. Okay. Just Discord. So, all right, so here we can kind of look at the bottom line yields for KRC, and you can see you have an operating cash flow yield of almost 16%, 16.8%. So, like, the market is, like, basically, like, I don't know, California is going to have an earthquake or something, and, like, half their buildings are going to disappear or something. Like the market's pricing in a lot of headwinds for Pacific Northwest REITs and for KRC. We look at some other stuff. I have specifically some REIT metrics that we can go over, and I can kind of try to show you more of that. So here we go. Pretty much similar that I have things that I'm looking at for similar to what I was looking at my main template. But the other thing that I'm going to look at is usually going to be like their liquidity and kind of their debt leverage. So what I'm going to be looking at REITs is the amount of that they're diluting, the amount of debt that they're taking on for the projects, and what I usually want to see is like a decent balance between dilution and then debt raise. And then I want to see basically the operating cash flows increasing on a per share basis at a better rate than their dilution. And I want to see that their like debt leverage ratios are basically kind of staying the same. So if we look here, we can see interest expense, operating cash flow, and then we can see their interest expense to operating cash flow ratio. So that's usually what I'm going to be keeping an eye out on for REITs. Then we got cash flow coverage ratios. So yeah. Later, Ricky. Thanks for joining, man. The first one, I was very interested to see how this was going to go. Like, just technically, from a technical standpoint, I was like, oh man, I feel like I'm going to be troubleshooting the live stream for like ever. But we are going to wrap it up here in 7 minutes, guys. So, or 6 minutes. So if you have any last questions, please shout them out. I think that went over basically all of the questions that we got in the Discord. So yeah, how's everybody doing? Yeah, no problem, man. I'm glad it helped. REITs can be tricky, man. And there's a lot of REITs out there that are just crap, like really crappy. So like you have to be very careful. Typically what I look for is I want to see a really, really high quality developer that is making basically accretive developments based off of the dilution they're doing and the debt they're taking on for those developments. And I want to see them having like very good balance in their interest ratios, their leverage ratios, the amount of debt amount of debt that they're taking on, the dilution that they're doing. And then I want to see them having a very, very high quality portfolio for whatever their like whatever kind of sector they're in the REIT market, right? Because they are the ones that are going to have the most, I would say, like power going forward. Because if they're not over leveraged and they have really good, you know, stable rent and cash flow, and the market tanks, they're going to be able to take advantage of more opportunities than the companies that are being forced to sell properties because they're having cash flow issues, or they can't cover their debts because their debts are coming due, and they can't roll them, or they're rolling them into like 7-8% interest rates, and their interest expenses are going crazy. So yeah, interest rates rising, I think affected the REIT market a lot. But yeah, I tend to be more optimistic. I think there are good opportunities out there. We'll just see if I end up actually picking the right ones or not. But all right, cool guys. Well, I am going to cut it off. Thanks for joining, and yeah, we'll try to do this probably once a week. I'm thinking Wednesdays. If there's a different time, comment it or like throw it in the Discord. And yeah, we might change this time a little bit. So give me like days and times, and I'll see if we can make this something that's like a regular weekly thing, and then just post the questions in the Discord. But yeah, Dex, my day was good. I am still getting back from the jet lag. I flew from, Portugal to Washington a couple days ago. Well, we got in yesterday, so like my jet lag is like kind of wearing off now. So I think I was up for what seemed like 2 days. We flew out of Lisbon at 2 p.m. and we landed at 3 p.m. the same day because of the time change. Like basically the entire flight was just taken up by the time change. But it's pretty crazy. But that was a fun trip. So it's good to be back though. Good to be back. So all right guys, have a good one. We'll catch you later. And yeah.